Ladies and gentlemen, good day and welcome to the Amber Enterprises India Limited Q3 and 9 months FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jasbir Singh, Executive Chairman, CEO, and Whole-Time Director of Amber Enterprises India Limited. Thank you, and over to you, sir.
Hello, good morning, everybody. On the call today, I'm joined by Mr. Daljit Singh, our MD, Mr. Sudhir Goel, Group CFO, and Mr. Sanjay Arora, Whole-Time Director of IL JIN Electronics. We have uploaded our quarterly presentation on the exchanges and I hope everyone had an opportunity to go through the same. We extend our appreciation to the Honorable Finance Minister for the enhanced outlay of Rs 40,000 crores towards the ECMS scheme. This scheme will serve as a catalyst for accelerating the growth of a robust electronics ecosystem in our country and creating significant employment opportunities. Further, we extend our sincere gratitude to Ministry of Electronics, MeitY, for granting approval under the ECMS scheme for Ascent K Circuits HDI PCB application and Shogini Technocrats multi-layer PCB application. These approvals are in addition to the earlier clearance received for Ascent's multi-layer PCB application. The expansion reinforces our long-term commitment to strengthening India's Atmanirbharta in electronics manufacturing ecosystem. We are pleased to share that land allotment of 16 acres have been secured in Jewar near New Noida Airport for Ascent K Circuit to establish state-of-art manufacturing facilities for HDI PCBs, and we look forward to shortly do groundbreaking to commence construction. Additionally, Amber Enterprises has been allotted 100 acres of land in Jewar Airport near New Noida Airport, enabling the company's future expansion plans. We extend our gratitude to the government of Uttar Pradesh for fast cabinet approvals of both projects and timely allotment of land parcels. Let me now take you through the quarterly performance. Consolidated revenue for the quarter stood at 2,943 crores, reflecting a growth of 38% over previous year. Despite weak underlying room AC industry, our operating EBITDA for the quarter stood at rupees 247 crores, growth of 53%. PAT before exceptional one-time impairment of Shivalik grew by 128% to 84 crores. Let me now take you through the divisional performances. Firstly, on the Consumer Durable Division. The Consumer Durable Division recorded revenue growth of 27% in Q3 FY26 and EBITDA growth of 22%. The growth is driven by the diversified product offering, adding wallet share within existing customers, expanding product portfolio. The room AC industry has transitioned to the revised higher efficiency BE star rating norms effective 1st January 2026, marking a key shift toward enhanced energy performance and sustainable cooling solutions. And the quarter witnessed a channel filling ahead of BE rating upgrade. We continue to deepen and strengthen our customer base both in room AC and commercial AC during this quarter. We are cautious about sharp surge in commodity costs and currency depreciation. While we are navigating these challenges, the pass-through will happen with a quarterly lag, as we have seen earlier. On the outlook, we believe industry will be flattish this year, while we continue to remain optimistic that this division should grow in the range of 13 to 15% for the full year basis. Coming to the electronics, IL JIN purchased 80% stake in Shogini Technoarts, a Pune-based printed circuit boards manufacturer with capabilities across single-sided, multi-layer and flex PCBs. Shogini brings a sizable 4.5 lakh square meter capacity boost and broadens division reach to diverse customer base spanning across automotive, medical, industrial, power and other segments. Coupled with Ascent expansion, JV with Korea Circuit and Shogini lays a strong foundation to emerge as India's most comprehensive printed circuit board manufacturer, offering solutions from single-layer PCBs to advanced HDI products across the value chain. Further, strengthening its position in high-value industrial automation segment, IL JIN has increased its holding in Unitronics Israel, taking its current stake to 45.5% now. Moving to the performance, the electronics division continued its growth momentum with revenue of 845 crore, reflecting growth of 79%, driven by printed circuit board assembly vertical PCBA, bare PCB board PCB, and new additions of in power electronics and automation electronics. The division recorded EBITDA of 88 crores, recorded growth of 157%, despite the margin pressure in the bare PCB vertical. The PCB vertical continues to face headwinds of CCS and price spike, and as a tier 2 B2B supplier, our ability to pass on comes with an inherent lag of almost 1 to 1.5 quarters, and we are confident to pass on these to our customers. Looking ahead, driven by strong growth momentum and portfolio of high value, margin accretive products, we expect FY27 full year EBITDA margins to be in double digits number. The electronics division, which began to address the shift of fixed speed AC to inverter AC in 2018, is now evolving into a full stack EMS company. It features PCB assemblies serving diverse customer segments and comprehensive bare printed circuit board solutions and box build solutions for hearable wearable, power electronics and industrial automation products. Now coming to the third division, Railway Subsystem and Defence. The record capex allocation in railway budget and announcement of 7 high-speed rail corridors positions India firmly on the path towards faster and future-ready mobility, which augurs well for the sector. On the performance, the division registered a growth of 20%, driven by railways, metro projects and defence solutions. On the expansion front, the construction is progressing well for Sidwal's greenfield facility for HVAC products, pantries, doors and gangways, and the facility is under machine installation phase now, and commercial production is expected to begin in Q4 FY26. With regards to Eugene Machinery joint venture for pantographs, brakes, driving gear couplers, this facility is now ready. Currently, the product development is underway and commercial production is expected to commence from second half of FY27 following requisite RDSO approvals. Special cooling products for defense applications are also gaining traction and are expected to contribute meaningfully in coming years. Backed by a strong order book visibility of rupees 2,600 crores plus and product portfolio expansion, we remain optimistic of doubling the division's revenue over next 2 financial years. During the quarter, one-time exceptional impairment loss has been recognized for our investment in Shivalik, through which we had invested in Titagarh Firma, Italy. The Shivalik investment was done primarily with 2 objectives. One, to have strategic association with leading rolling stock manufacturer Titagarh. Together, we have been actively contributing to some of the country's most prominent mobility initiatives, including key metro projects and Vande Bharat. Our collaboration with Titagarh has translated into business visibility worth about 700 crore for heating, ventilation, air conditioning products, as well as new products which were launched, doors and gangways, and which shall continue to grow in future as well. Secondly, the objective was to open export opportunities for Sidwal through Italy venture. However, Titagarh Firma turnaround did not materialize in the manner we had envisioned due to the operational and other challenges. And to curtail future losses, one-time exceptional impairment loss has been recognized during this quarter. Now let me hand over to Sudhir Goyal, our CFO, for financial highlights. Thank you.
Yeah, hi. Good morning, everyone. Let me first take you through the consolidated financial highlights. For the Q3 financial year 26, we clocked a consolidated revenue of 2943 crores, up by 38% over last year. We recorded quarterly operating EBITDA of 247 crores, a growth of 53% year-on-year. For clarification, operating EBITDA is before impact of ESOP expenses and other non-operating income and expenses. Profit for the quarter stood at 84 crores before impairment of investment in Shivaliks of 94 crores, reflecting a growth of 128%. However, PAT is after considering one-off provision of 9 crore pertaining to new labor codes. Let me take you through 9 months financial year 26 financial performance at the consolidated level. We recorded consolidated revenue of 8039 crores, growth of 29% over last year. Operating EBITDA of 608 crores, resulting in a growth of 26% year-on-year, and profit before impairment loss of 158 crores, reflecting a growth of 19%. Now let me take you through the divisional performance overview. Firstly, revenue and operating EBITDA details of the divisional performance are not comparable with the published segmental results. Starting with the Consumer Durable Division, the Consumer Durable Division reported revenue of 1971 crores in Q3 financial year 26 compared to 1555 crores in Q3 financial year 25, reflecting a growth of 27% year-on-year. Operating EBITDA for the quarter increased by 22% year-on-year and stood at 141 crores compared to 116 crores in Q3 financial year 25. Coming to the Electronic Division performance, the revenue for the quarter increased to 845 crores in Q3 financial year 26 compared to 472 crores in the same quarter last year, reflecting a growth of 79% year-on-year, driven by PCBA vertical, bare PCB and new additions. I would like to emphasize we acquired Shogini on 1st of December and consolidated P&L includes results for 1 month only in respect of Shogini. Operating EBITDA for the quarter recorded growth of 157% year-on-year and stood at 88 crore compared to 34 crore in Q3 financial year 25. Moving to Railway Subsystem and Defence divisional performance, the revenue for the quarter increased to 127 crores compared to 106 crore in Q3 financial year 25, reflecting a growth of 20% year-on-year and the resulting operating EBITDA of 18 crore, growth of 49% year-on-year. With a robust order book and expanding product portfolio, we remain confident in doubling the divisional revenue over the next 2 financial years. On the balance sheet front, LG Electronics has successfully concluded fundraise with the entire 1750 crores received from marquee investors. As we embark on a growth path in our electronic division, we stand on a strength of robust balance sheet. Thank you. Now I request the operator to please open the floor for the Q&A.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. In order to ensure that the management is able to address questions from all the participants in the conference call, please limit your questions to 2 per participant. We'll wait for the question queue to assemble. The first question is from the line of Natasha Jain from Phillip Capital. Please go ahead.
Thank you and good morning, team. Congratulations on a very good set of numbers. So my first question is on RAC. Given that there was a push in the third quarter on account of DE and then there was low-cost inventory, how should we see fourth quarter, from a very near-term perspective, and then calendar 26, given that there is high amount of inflation and the entire GST benefit probably is written off and the cost could be even higher than that. So how should we read calendar 26 from an RAC point of view?
Good morning, Natasha. See, this is how we look at room AC sector in the country, and as an industry, we feel that if you see Q1 was -5-10%, then Q2 was -35%. We saw a little growth in the industry in Q3 with the primary sales moving ahead in lieu of the energy rating. So we feel that the industry should be flattish this year. Whereas we have again and again maintained our guidance, and we are hopeful to deliver about 14 to 15% kind of a growth. Let me give you a little background on air conditioning industry, Natasha. That in last 25 years we have seen 7 bad seasons in this industry, and 2 COVID waves hit us both in March. So 9 bad years for the industry in last 25 years. 25 years back, market size was 500,000 number, just 5 lakh numbers, and now we are at 14 to 15 million number, 1.4 to 1.5 crore number. So I expect that, in future also these kind of issues will keep on coming on the currency and commodity issues, be table revisions. But looking into the households, looking into the per capita income growth, looking into the adequacy of power, and the desire of comfort living, I believe that this industry should grow in the range of 12 to 15%, at least for next 4-5 years. And thereon, once we cross 4,000 per capita income, this will further grow at 20 to 25% range. This has been historic in all the countries. So we believe that on the calendar year 26 basis, industry should be in the range of at least 12 to 15% growth path.
So this would be value growth that we're talking about, or just RAC volume?
Now I'm talking about volume growth. Value may be little higher because of higher increase in the cost.
Understood. Sir, and my second question is, very recently Mitsubishi Electric had announced that they are doing a 2,100 crore capex and backward integrating into RAC and compressors. Now, given that all Japanese and Korean brands are our prime customers, just want to understand how should we read this from Amber's point of view, because I believe Mitsubishi is one of our biggest clients, and does it entail any risk for us?
No, there is no risk, Natasha, since you have all seen that 2021 when PLI got announced, or 6 major brands announced, which are all our customers, their own factories. And markets did assume that Amber will not do well, and our stock price was hit unnecessarily. But, we could see that Amber moved into a different category. We started offering our products in the component shape, and we kept on growing more than the industry space. This Mitsubishi Electric, yes, it's our client. This was told by them 2 years back, and we have already gone into supplying the components for the factory which was inaugurated. We are very much part of this, and our association continues from here on with Mitsubishi Electric Group.
Got it. Great to hear that, sir. Thank you and all the very best.
Thank you, Natasha.
Thank you. The next question is from the line of Dhruv Jain from Ambit Capital. Please go ahead.
Thank you so much for the opportunity, and congratulations, team, for a very good set of numbers. So my first question is an extension of what you said, right? So you mentioned that the industry should grow at 12 to 15% CAGR going forward. And with the brands, with the PLI now getting over, and over the last 4 or 5 years, we've seen that the brand's share of overall manufacturing has gone up. Should we now the EMS share moves up, given the fact that PLI is getting over, and for growth for you guys should be AC plus industry, because you gain EMS gains share?
Dhruv, as Amber's B2B capability on components and on the finished goods capability side, we have seen this kind of shift in-house outsourcing 3 times now in last 25 years. Whenever this kind of shift has happened, we've moved in tandem to the industries or our brands or our customers, policy change. And we have established 24 factories now in vicinity to customers. So any customer who would like to manufacture on their own, we are very happy to supply them the components. I'll just give you example of automobile in a true reference. If Toyota puts up a factory, they will do engines on their own, car chassis on their own, car bodies on their own, and assembly line on their own. But will Toyota ever produce tires for their own? Audiovisual systems, glasses, seats, bumpers. So similarly in our category also, whenever a brand puts up a factory, they do some kind of a backward integration plus assembly and plus labs, but other components are required to be supplied just in time by suppliers like us. So we have a very comprehensive solution for the customers. If they want to buy full boxes, we can give full boxes. If they want to buy only components, we are happy to supply components only. And that's what we have done in last 25 years. Moving forward, this trend will continue. We don't control the change of policy of a customer, whether they want to insource or outsource. We are there as a backbone of them as a supply chain solution provider. Plus, what we are doing over and above is we are expanding our product portfolio into the commercial air conditioning space. We have already successfully launched our tower series, cassette series, ductable series from 3 ton to 17.5 ton. And we are also bringing some new products as we go ahead. So that is over and above. And plus to this is our non-room AC components, which we deliver as a solution for refrigerator, washing machine, microwave oven, etc. So all these three things put together, I think we will continue to outnumber industry. Maybe in a year, 2 years time, 3 years time, we may move in tandem to industry, but eventually we have seen that we have surpassed the industry by the numbers, good numbers every time.
Fair enough, sir. So my second question is on finance cost, right? So despite the QIP, we have seen the finance cost go up marginally, on a QOQ basis. So if you could just help us understand the reason for the same.
Yeah, so hi Dhruv, this is Sudhir. So finance cost has increased because of that there was some change is happening in the energy rating, and we have built some inventory at a lower cost in terms of copper as well as compressor, which has increased the cost of finance cost. Plus, we have acquired Shogini in the first of December, when we have paid around 575 crores payout to acquire that entity. So finance cost includes that as well. And also we increased our stake in Unitronics post our first acquisition on 9th of October when we acquired 40.2%, and now we are at 45.5%. So that has led to an increase in finance cost. But you will see that it will start coming down in the current quarter.
One question, if you could just give the numbers of Ascent, Shogini.
Dhruv, since Unitronics is a listed entity in Israel, and their results are not still come out, so it is difficult for us to give you in the electronic division entity-wise numbers, because that will be insider information, and it's not wise to give you that number. We'll give you once those numbers are out individually.
Okay, sir. Thank you so much.
Thank you.
Thank you. The next question is from the line of Sonali Salgaonkar from Jefferies. Please go ahead.
So thank you for the opportunity and congratulations to the team for a great set of numbers. So my first question is, the consumer durable division with a growth of about 26% year-on-year on sales is far ahead of most of the peers who have reported, including the branded or the contract manufacturing. So it's a very positive thing, but would you like to help us understand what drove this?
Well, Sonali, couple of things. We've increased our wallet share in some customers, and our non-AC components is actually paying dividends now. That's and plus the new product categories which we have launched. So all put together is delivering this number. I think team has worked very diligently on all fronts to increase product portfolio, to increase the wallet share in existing customers, to work on non-AC components, where injection molding has done pretty well. We have started supplying to customers in telecom sector and to energy meter customers, and plus of course the refrigerator and washing machine and microwave oven customers are also gaining traction, and our ductable ranges of commercial ACs are also growing. So all put together has led to this kind of a number.
So great to hear that. Just an extension to this on the AC industry. After the liquidation that we saw in December, what is the current inventory level, and are there any initial trends you fathom of the upcoming summer?
Well, inventory is varying from customer to customer, I think. But overall, at an industry level, if we sum it up, I think industry is reached to almost a normalized inventory level at the moment. So if there's a spike in summer, we will see a good summers ahead.
It's great to hear that. So my second question is regarding the capex outlook for 26 and also 27, if you could help. And how should we look at the journey of Shivalik from here on, now that we have taken the impairment loss?
Hi Sonali, this is Sudhir. So current year capex, we are expecting it should be around 800 crores. And for the next year, the expenditure which will be capitalized should be around 1200 crores, 11 to 1200 crores. And for Shivalik, so now we have explained that there will not be any further loss in the Shivalik because we have taken a complete impairment of the investment. And we don't see now anything coming from the Shivalik, and we'll be focusing on our Indian operations and expanding the same.
So great to hear that, and all the best to the team, and congratulations once again.
Thank you.
Thank you. A request to all participants, please restrict your questions to 2 questions per participant. For more questions, please rejoin the queue. The next question is from the line of Inderjeet Agarwal from CLSA. Please go ahead.
Hi, thanks for the opportunity. 2 questions. First, when we look at your guidance of 13 to 15%, that implies a mid-single-digit kind of growth for RACs in fourth quarter. So would you still think that the industry would actually end up being flattish or negative in the fourth quarter as a result?
Well, I mean, I think if you sum it up, Inderjeet, for all the 4 quarters, quarter 1 I explained it was -5, quarter 2 was -35. Quarter 3 has been a little slightly above 0. It's like 3 and 5 number. So quarter 4 should be flattish at least. I mean, even if they do well, so overall it will come to be like a flattish number. You know, that is our estimate looking into it.
Sure. Thank you. And sorry, please, sir.
And I believe that, I have always guided that in air conditioners, due to the heat waves, the sales move up 1 month ahead or it get postponed. So I would urge everybody not to look at RAC sector on a quarterly basis rather than on a complete financial year basis. I think that will be a relevant way to look at the RAC sector stocks.
Sure, this is helpful. Second, Sudhir talked about inventory built up of copper and compressors ahead of the table change. I just want to understand, what does that regulation state? Does it state that post 31st December you cannot sell to the brands or retailers, or the retailers cannot sell? Till when can we manufacture old BE norm air cons?
Yeah, so basically the norm says that the manufacturing cannot happen for the old products post 1st January, whereas the manufacturer can supply the old inventory for 3 months. Coming to the retail part, the retailers are allowed to sell the old inventory for 6 months. So that is how the government's norms are. So we cannot manufacture. So first, before 31st, we have to stop all the old models.
Sure. So the inventory that we have built up will be utilized in the next, we will see that the inventory drawdown when we see March quarter results. Is that understanding correct?
That's right, yeah.
All right.
Especially on the primary.
Sure. Thank you so much.
Thank you. The next question is from the line of Pulkit from Goldman Sachs. Please go ahead.
Sir, thank you for taking my question, sir. 2 questions. First, could you give a rough breakdown of consumer durables between AC